Welcome back, guys. Jay Martin here, CEO of Cambridge House, and my next guest is George Gammon, the Rebel Capitalist, host of the Rebel Capitalist podcast, the YouTube channel, and now the physical event, Rebel Capitalist Live, which he just hosted in Miami, Florida. And next up is Houston, Texas. So I was really excited to have George on the show. Very much like me, he interviews a very eclectic mix of guests for both his podcast and his YouTube channel. And what I wanted to learn from George was that of everybody he talks to, all the macroeconomists and investors and legendary investors that he has on the show, does he see consensus in their thought process anywhere? Does he see massive room for debate in their thought process anywhere? And where inside of that does he see opportunity, and how does he organize his investment portfolio accordingly? So, as always, if you enjoy this, right beneath this video, there is a pinned comment where you can subscribe to my free weekly newsletter where I debrief conversations just like this and plenty others, in addition to mentioning if I'm putting capital anywhere as a consequence of these conversations, where that is. Okay, George Gammon, the Rebel Capitalist. Enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by George Gammon, the Rebel Capitalist. George, it's about time I had you on the show. How are you?
I'm extremely well. I'm excited. Thank you for inviting me. I've heard a lot about your company. In fact, we were talking earlier about you doing events. And I think the very first kind of investment in event I did is I helped Eric Townsend and Patrick Ceresna out with Macro Voices Live. Yeah. And that was in January 2019. And I think we planned it right around your event. So our attendees could go to your event and go back and forth there. So yeah.
Wild. I had no idea. Yeah, I remember that very well, and coordinating a little bit with them up front.
Yeah. And I know like Brent Johnson spoke at our event, and he's going to just fire down, because we were very close. So he's just going to fire down the street over to your event. And I think you might have coordinated some of that with Eric as well. I'm not sure. I just helped him. My last business before I retired was a convention business. So I was a huge fan of Macro Voices. And Eric and Patrick had mentioned something about doing a live event, but they're kind of apprehensive because they had never done one before. And they're like, well, we really don't have a budget for an event planner. And so I somehow got Eric's phone number. Okay. And I called him up and I said, Eric, listen, if you guys want to do a live event, I'm happy to do it for you. I used to do live events with 5,000 and 6,000 people. Doing something like Macro Voices Live would be, trust me, man, it would be child's play. And he goes, yeah, well, I really appreciate it, George, but we probably couldn't afford your fees. And I said, no, trust me, you can afford my fees because they're zero. I'll do it. I'm happy to do it free. I go, I've gotten so much value out of your podcast, and I love what you guys do so much. I'd love to organize the event and just go up there and meet the people like Jeff Snyder and Brent Johnson and Juliet DeClerc. And so that's what we did. And I think Eric specifically coordinated it with your event, like I was saying. So that was my first introduction into the investment conference space. And I absolutely loved it.
Amazing. Yeah. Wow. Yeah. Eric and Patrick both spoke at my event that year. We helped push some tickets or something, but
yeah. I think there was something like that. Yeah. So I organized the event for them. I set up the hotel. I negotiated the ballroom, did the room block and all that stuff.
Wild, man. Small world. I had no idea. I love that. Yeah. So was that your segue into doing what you do now, George? Because I know you've had a handful of careers. I've watched like real estate investment videos that you used to put together when you would tour the streets of Medellin and look at apartments and condos and whatnot. But became a bigger fan once, I guess, Rebel Capitalist became what it is today. So talk to me about that. And especially for anybody who's watching this, my audience, who maybe hasn't stumbled onto your show, your content yet. How did you begin what you do now, and what is it that you do, George?
Yeah, well, I retired in 2012. I'd been an entrepreneur for many years, and I knew I wanted to invest my own money. But as you know, the skill set of an entrepreneur and the skill set of an investor are almost completely opposite. One, you've really got to look at risk management, and the other one, you got to see opportunity in everything and take on just an insane amount of risk. And fortunately, I understood that going into it, but I knew nothing about economics. And when I mean nothing, I mean, I didn't know what the Fed was. I didn't know what really a balance sheet was, because all my businesses that I had were all just P&L. We never really had much debt or anything. I knew what a balance sheet was, but I wouldn't be able to read one of a Fortune 500 company or something like that. I didn't know what a yield curve was. I didn't really know what T-bills were. I mean, I knew nothing. I was just strictly an entrepreneur that knew how to make a lot of money in small and mid-sized business. So I knew that I had to kind of educate myself. And I was in Singapore, actually, and I was staying at the Marina Bay Sands. There's about 10 minutes that I had to blow before a dinner date. And oddly enough, I was just scrolling through YouTube, and I stumbled across Milton Friedman's Free to Choose series, the one that he did back in the early, I believe it was the late 70s or early 1980s. And when I started watching them, I mean, I was instantly engaged. And I mean, he articulated everything that had been in the back of my mind for so many years, not only just as an employer, but as an employee. And he really described the world the way that made a lot of sense to me. And it just resonated with me so much. And so then from there, I started studying Thomas Sowell, who is one of my favorite economists, probably my favorite economist. And then I started to kind of research and study investors who kind of had that Austrian mindset, that for framework, because that's always what made a lot of sense to me. The Keynesian approach never ever made sense. It just, for whatever reason. So I really started to get into guys like Jim Rogers and Jim Grant and Doug Casey and Rick Rule and Schiff and Jim Rickards, and guys like this. And so that was kind of my introduction into investing. But Jim Rogers was always my favorite. And I think it's because my father was very old when I was born. And so he passed away at 92 in 2005. And he was my hero. I was extremely, extremely close to my father. I mean, every son says that, but trust me, it was on a whole different level with my father. We were very, very close. So, and Jim Rogers, I can tell you, if you watch Jim Rogers, it's almost like watching my father as far as their mannerisms and the way they speak. And Jim Rogers is very simplistic, but if you actually think about what he's saying, this dude knows his stuff, And so anyway, I think that's probably why I enjoyed watching him so much initially. But I wanted that his approach really made sense to me. That you just buy things when they're cheap, and you sell them when they're expensive, and you buy things that are unloved that people hate. And then if you do that, you've got a little bit of an edge there. So I looked around me, and again, this was 2012. And so I looked around me and I said, okay, well, what's cheap right now? And I looked at a chart of the housing market in the United States going back to 1900, adjusted for inflation. And I saw obviously this big run up to 2006, and it crashes down. And it seemed like we were about down to our historic trend line that we had been going all the way back to 1900. So now that in and of itself doesn't indicate that the market was cheap, but what was cheap was the cash flow. The cash flow was insanely cheap that you would get from these rental properties. So I pretty much went all in with real estate in 2012 as a result of Milton Friedman going from Thomas Sowell, going from Jim Grant to Doug Casey to Jim Rogers. That's kind of my path to real estate. And I kind of figured it out in the Midwest. I was investing there a lot, did well. And then I made a lot of money as an entrepreneur overseas. So that was kind of the next step. So fast forward to 2015. And now, although I was investing in real estate and I really liked it, my passion was always macroeconomics. it was just, and when I mean passion, I mean just 8 hours a day. As soon as you wake up in the morning, you're listening to a podcast. In the shower, you're listening to an audio book. At lunch, you're listening to, XYZ YouTube video. I just could not get enough of it. It was fascinating because you had this Rubik's cube and you're always trying to figure out, but there's always different cross currents and variables that you have to put into play to try to predict. I mean, no one can predict the future, but just to get a handle on what the probabilities may be of specific outcomes. So I was doing that the whole time, but I didn't know that much in 2015, but I knew enough to know that oil got real cheap. That was back, oil got down below 30 back then. It was either the end of 2014 or 2015. I can't recall, but right around there. And I was investing in South America at the time in real estate. And I wanted to go long oil, but I didn't know how the hell to do it. And and one thing I learned as an entrepreneur that stuck with me and served me well is you got to know what you don't know. And I knew that I didn't know anything about oil. So I said, well, but I want to go long oil. And then I looked at the Colombian peso and I said, okay, well, the Colombian peso is loosely tied to oil because 50% of their exports are oil based. And I said, okay, well, I don't know anything about FX either, but I do know real estate. So if I buy real estate denominated in pesos, maybe that's kind of like going long oil in something that I actually know something about.
Sure.
And then I figured too, if I could make money on the buy side and force some appreciation through my team remodeling, then I'd have a bit of a buffer. So if the oil play or the FX play went against me, sure, then I'd kind of be at a wash. And if I was right on oil and the FX, then I'd have kind of like a double whammy. Like a double, kind of increase your profits without using leverage. So that's exactly what I did. And I've been investing in real estate in Medellin, Colombia ever since. And that was 2015. Then 2019, we were doing all of these remodels and I had a team of 20, 25 people there. And my designer and my architect are a husband and wife team, young, charismatic. They're like family to me. And so I thought, why don't we just do a TV show? Because they're very popular in the United States. So why on earth wouldn't they be popular here? I knew nothing about it, but I went down to the local TV station and pitched them on this idea that a gringo that didn't know Spanish should produce a show that should be on their prime time slot at 8 p.m. on Sunday nights. and they initially looked at me like I was absolutely crazy. But I said, no, trust me, it'll work. And I had to figure out, and they said, okay, George, what you come back in 4 weeks with a trailer, like a 5-minute trailer or something, sure, or a demo reel, whatever you want to call it. And then we'll go from there. We'll let the executives see it and they'll kind of, keep you posted after that, kind of blowing me off, basically. Okay. So I had about 4 weeks to figure out how to produce a TV show, a reality show, and a good one. So I just watched as much reality TV shows as I could. And I just reverse engineered it, the editing, because there's a science to it as well as an art that most people wouldn't even recognize. So we did this demo reel and I thought it was fantastic. So we took it in to the executives. They watched it, the 5 minutes afterwards, they look around and they said, well, we love it. That was amazing. And I said, okay, well, you guys are going to get back to me in 2 or 3 weeks because that was the original game plan. And they said, no, we don't need to get back to you. This is, if you can do this for 13 episodes, you got a deal. And so I said, fine, we'll do it. So we did 13 episodes there. I had to hire all the editors. I had to do the directing. I was the executive producer. I was the producer and I was in the show along with Angie and Joaquin. So anyway, it was called Vida en Remodelación, which is loosely the remodeling life in Spanish. Right. And so then after we took a break after the last episode, and I had all these amazing TV editors and camera people and whatnot. So I'm like, well, we'll go ahead and start a YouTube channel because I don't want to, I want to keep them productive. And I didn't think anyone would ever in their right mind want to watch a YouTube video on macroeconomics. I thought there's just no way there's a market out there for that. So I'll just go ahead and do real estate videos. And we messed around with all the editing. And of course, as most YouTube channels, the first few videos were absolutely horrible. But then kind of your passion comes up to the surface and you're like, I got to do a video on this macro topic. So I did a couple of them, and sure enough, those were the ones that were really popular, and those were the ones that I liked doing. So 8 months later, we had 100,000 subscribers. Now we've got, 320,000 with the one. I've got another smaller channel with 20 or 25,000. We've got the Rebel Capitalist Show, which is a podcast that does like 50,000 downloads a week, something like that. And then we just did Rebel Capitalist Live, which is our first live event. We had 700 people, sold out very quickly. And that's what I'm doing now.
I love it, man. I love it. Okay. So thanks for going into that, George. I appreciate the journey. And when I watch your stuff, you can see, you mentioned like passion eventually shines through. Dude, you can see it when you watch your stuff. You get very excited and it's fun to watch. Okay. Now my question for you, because you have a very eclectic mix of guests on the show, and some that are familiar to my audience, but many that aren't. My question for you is, with all the conversations that you've had recently, let's think like the last quarter. Okay. Mm-hmm. Where are you seeing consensus anywhere right now, George, in the macro landscape among all of your guests where 95% are agreeing or aligned on one idea?
No, because I would try to interview different people. Because let's look at the Bitcoin convention.
Sure.
As an example. And I don't want to throw them under the bus because it was a great convention. I enjoyed going there. But every single speaker they had was pro Bitcoin, obviously. Yeah. Because that's the demographic that they're trying to reach. So they just catered to this echo chamber and just had this positive reinforcement for a belief system that you already have. And if that's what you're looking for, you don't want to come to my channel. Because although there will be a consistent theme of personal freedom,
sure,
and liberty, there's not going to be a consistent theme of the dollar is crash, or the dollar is going to go down, the dollar is going to go up. It's always going back and forth, and I'm trying to go through these things in my own mind. And one of the things I always say on my show and on my videos is there are no certainties. There are no certainties. There are only probabilities. So, if you think that there's a 100% certainty that gold is going to $50,000 an ounce, you got to check yourself there, because now there may be a high probability, but there's not a certainty. So you can't set up your portfolio in those terms, and that's what most people do. And so I really try to get out of an echo chamber. As an example, I'll interview my good buddy Peter Schiff. And the very next day, or maybe the same week, I'll interview Professor Richard Wolff, who is a Marxist. And that's not my view. I'm a libertarian. I'm a free market guy to the core. But as long as someone's intellectually curious, and as long as they're intellectually honest and respect, I want to have a conversation with that person. And I want to try to figure out, where they're coming from. But I think going back to your main question, whether I'm interviewing a Jeff Snyder or a Brent Johnson, who may be short-term bullish on the dollar. And I hate to use the word bullish. And I know Snyder doesn't like that term because he doesn't like the dollar. He just thinks that for a lot of macro reasons involving repo and the euro dollar market and a shortage of dollars, that it's just going to go up against other fiat currencies. Yeah. But that doesn't mean that he thinks it's a great currency.
Right.
And I think Johnson would fall into the exact same category. So whether you're talking to individuals like that, or maybe Lynn Alden's more like Luke Gromen in kind of the dollar bear camp. They see it going down before it goes up significantly. I mean, Brent thinks it could go up so high that we could have to have a Plaza Accord 2.0, talking about 120, 130, 140, maybe even on the DXY.
Right.
But one thing they all do agree on is that the dollar will crash. It's not a matter of if the dollar will lose the reserve currency status. It's not a matter of if the dollar will crash. It's a matter of, does the dollar spike higher, and that's what causes the inevitable crash, or does it just continue to go down quickly, like just straight down, like Schiff may argue, or does it just gradually kind of grind down slowly, like we've seen other reserve currencies in the past kind of lose their status? And I think Luke and Lynn would fall more into that category. But that's the one thing they all agree on is kind of the end game, looking out maybe 10, 15, 20 years. And they also all agree that the system in and of itself is broken. And in order for the United States economy to get back on solid footing, where the economy is structurally sound, and where the economy is sustainable and very resilient, the system itself has to change. We can't keep doing this BandAid over Bretton Woods, which is basically what we have right now. And if you'd like me to explain that further, I'd be happy to. But that's it's kind of another thing that they all agree on, especially people that are really smart, that have studied it quite extensively. They don't think that we can continue to do what we've been doing over the last 2 decades just forever. It doesn't work that way. At some point in time, you got to pay the fiddler.
And what are you seeing there when you talk about, a Band-Aid over Bretton Woods, George? What are you seeing that troubles you so much?
Well, it's not that troubles me. I've got to give credit to all the brilliant people that I've learned from, like the individuals I just mentioned. But, in Bretton Woods, what we did in 1944 is we tied the dollar loosely to gold, and then all these other currencies kind of pegged their currency to the dollar. And we thought that system would work. That was the general consensus. You got to give a hat tip to Keynes, because Keynes said, no, that ain't going to work, guys. And he came out with something called Bank Core, which was a global currency, which he thought would be a better solution, which ironically enough is where the IMF came up with their SDR. The SDR is not an original idea. That's just basically taking the idea Keynes had back in 1944 and just, having a little different spin on it. But then also Triffin came along, and I'm sure most of your listeners and viewers have heard of Triffin's dilemma or Triffin's paradox. And he agreed with Keynes, and he said, listen, guys, if you have the dollar as the global reserve currency, in other words, in order for the global economy to function on all 8 cylinders, they need a consistent supply of dollars. Okay, well, how do you get those dollars out of the United States? Because these dollars are created by the commercial banking system that has dollar-denominated deposits. So most of those dollars are in the U.S. And when I'm talking about dollars, I'm talking about broad money. The Fed, we're not talking about the Fed money creating or the Fed creating bank reserves or base money. They're specifically talking about dollars, because that's what those economies would need, because they can't access those bank reserves. That's a whole nother rabbit hole. So they thought, well, how are they going to get these dollars out of the United States? Well, you have to do that through a trade deficit, right? Because if the United States is importing more goods than they're exporting, they're going to have a trade deficit. So the balance there is going to have to be made up with dollars, us being an exporter of dollars. So we're going to have this trade imbalance. We're going to have a trade deficit, but then on the other side, we're going to have a dollar export surplus, if you will. So all these dollars go out. Now that's going to be the funding for global growth, because the globe runs on dollars, especially once you bring into play the dollar being denominated, or oil being denominated in dollars. In other words, the petrodollar. Yeah. Right. So that's even more demand for those. So what that means, if we, the United States, always run these constant trade deficits, is it hollows out our manufacturing base, which is obviously what we've seen today. because we're always importing more stuff than we are creating. We're consuming more than we produce is the bottom line. And then we're paying for that excess consumption with just these green pieces of paper that we send to foreigners that produce all the stuff. So they knew, Keynes knew, and Triffin knew that was totally unsustainable. But and a lot of economists kind of figured that out, one of which was Milton Friedman in the 1960s. And he kind of, and him and some others, they looked around and they said, okay, well, it's already 1960. That was 1944, or maybe it's the middle of the 1960s. And they say, how has the world gotten these dollars? Because we haven't run big enough trade deficits, if they had run trade deficits at all, to get the dollars out of the system. So what's going on here? How has it not collapsed? And they came to the conclusion that banks outside of the United States, some maybe had dollar deposits, maybe some didn't. They started creating dollar-denominated loans. So as an example, a bank in the Cayman Islands, if you were XYZ Corporation in Saudi Arabia and you needed a loan denominated in dollars, you would go to that Cayman Island bank and they would give you a loan for $1 billion. So that $1 billion did not exist before then because the bank lent that into existence. Right. And most people don't know this either, but the majority of the banks, like 99% outside of the United States, do not have reserve requirements. So if they had $1 million deposit in dollars, and that's even iffy, they might not even have had to have the dollar deposits in the first place, right? But they can create just almost limitless dollar denominated loans. And the conclusion that Friedman came to is that's what had happened. It's the free market outside of the United States started creating the dollars that they needed to run their economies and run their corporations at full capacity without having to rely on the United States. This system is what some people refer to as the shadow banking system. Yeah, because it's really unquantifiable because it's out of the purview of the Fed, but it relates to dollars. Most people call it the euro dollar system. Right. But most of the people that define the euro dollar system simply define it as a system of dollar denominated deposits outside of the United States. And that's like, that's just 1% of the story. They're not getting the other 99%. Really, the only person, in my opinion, that truly understands this is Jeff Snyder, who I've interviewed several times and was just at Rebel Capitalist Live. But what happened, so fast forward, so this system was actually working quite well. It was providing the dollars that all of these other economies needed to grow. And I want to remind people too that fractional reserve lending in and of itself is not bad. It was a product of the free market. A lot of libertarians and Austrians come to the conclusion inaccurately that we would not have fractional reserve banking if not for some sort of government intervention or regulation or the central bank. And that's not true, because back in the 1800s, we had something called free banking. And that's when there was no government intervention in the banking system whatsoever. We did not have a central bank, and banks actually issued their own currencies right here in the United States. So we had this fractional reserve system that was created by the free market. But see, the key there is when the banks aren't being bailed out and you don't have this moral hazard, banks are incentivized to lend productivity, not for consumption. Sure. Because they want to make sure they're getting paid back, right? Well, so what you have is, yes, you have the money supply increasing, but the money supply increasing in and of itself is not inflationary as long as the amount of goods and services that are being produced are going up and increasing at the same rate, if not at a faster rate. And that's what we saw throughout the 1800s. So my point, going back to the Eurodollar system, is we didn't necessarily need to see Weimar Germany hyperinflation because we're creating all these dollars, because most of those dollars weren't going into people just going on vacation. They're going to factories to produce widgets, to produce stuff. And the more stuff you had, you need an additional supply of dollars, and you don't see significant price inflation. And you might even see price deflation if the amount of goods and services are being created at a faster rate than the amount of dollars that are being created. So this system worked well until we got to, I would say, probably the early 1990s. And then it started, Wall Street got a hold of it. And like Jim Grant always says, Wall Street has a tendency of taking a good idea and making it a very, 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 very bad idea. And I think it started with Salomon Brothers. And this is a story I got from Emil and Jeff in their fantastic podcast called Making Sense, where there was a trader, we'll call him a rogue trader, with Salomon Brothers. And he was literally trying to buy every single treasury that was being auctioned off, literally every one. And if sooner or later, the Federal Reserve kind of saw this and no, you need to stop doing that. We don't know what you're doing, but something's nefarious here, something we don't like. Sure. So the guy wouldn't stop. And what he would do is he would have his buddies with all the other investment banks try to bid on these treasuries, and then in a roundabout way, get them back to him so he would have control. And I don't know if he ended up getting fired or something like that. But and what was funny is the Fed or the authorities, they did study and they tried to figure this out 2, 3, 4 years later, and they couldn't figure out what he was doing. They never really put their finger on it. So what he most likely was doing, taking these treasuries, and he was using them as collateral to create derivatives and to create certain products through the repo market, now what we now know as the repo market, which has a lot to do with the Eurodollar market, because that's the dollar plumbing system for the entire globe really starts with the U.S. repo market. So I don't want to go off into an extreme tangent there, but this is when we started to get a lot of this financial engineering. Right. And as a result of Wall Street taking what was happening with the banks, and I think it might have been as a result, too, of the moral hazard that was created by the government bailing out everyone in the S&L crisis. Maybe that's just a hypothesis, who knows? Sure. But so you had this system that was working, and then it just went completely berserk and bananas. And that's when we started to transition, in my opinion, from an economy that's driven by the production of goods and services, let's call it the real economy, to the financial economy, and a completely financialized economy that we have today. And the example I always use is like a hot air balloon. Right. We've all seen those before on Sunday mornings, when they're floating up and they've got this big, balloon full of hot air. And then at the bottom, they just have this little basket, right, where the people are. But that basket is going to go wherever the balloon goes. If that balloon goes down, the basket's going down with it. If the balloon goes up, the basket's going up. Oops, excuse me. I'm sorry.
No worries.
And are you still there?
I'm still here. Yeah.
Okay. I don't know if you can see me. Can you still see me?
I can still see you. Yeah.
Oh, there we go. I'm sorry. My thing came up here. Okay. So you've got that basket. And before what you want in a healthy economy is where the hot air balloon itself is the real economy. And the basket is just the stock market and the financial economy. That makes sense because the stock market should be a reflection of how well the real economy is doing, because those are the businesses in the real economy. But now what we have is this perverse system where it's the complete opposite. The hot air balloon is the financial economy, and the real economy is just the little basket. And that's why we're so addicted, and we have to have these asset prices continually going up and up and up, or else we're going to have a massive deflationary bust. And when I mean deflationary, I'm talking about asset prices. I'm not necessarily talking about consumer prices. So you had this this liftoff, this trajectory with the financialization, let's say in the early 1990s, that came to an end in something called the GFC, the global financial crisis that we all know about in 2008. And all of a sudden, this came crashing down there. Everyone was levered up to everyone in all these investment banks and, the mortgage-backed securities and all of these derivative products that we all, all the CDSs and all the things that we've heard about. It came to an end. And so really, it wasn't necessarily the housing market that created such a massive recession. It was really the breaking down of that euro dollar system that was supplying the globe with the dollars they needed. And at the time, it was also supplying, when you include repo, it was supplying the liquidity for these investment banks, such as Lehman Brothers, such as Bear Stearns, right? And you can see this because if you look at the reserves in the system, or if you look at the Fed's balance sheet, the Fed's balance sheet back prior to the GFC was only about $800 billion. Now it's 8 trillion.
Right.
So something's not working the same, or if you look at the reserves in the system that the banks had back then to create and to make sure that the dollar funding markets and the plumbing of the system, the plumbing of the financial economy was functioning, the reserves in the system, maybe like 40 billion, something like that. I haven't looked at it lately, but now it's close to 3 trillion. So it's like, how on earth can we have the exact same system and it's healthy at 40 billion and it's also healthy at 3 trillion? That doesn't make sense. How can we have a system that's healthy when the Fed's balance sheet is at 800 billion, but it's also healthy when the Fed's balance sheet is 8 trillion? What? Right. Something that doesn't pass the smell test. Right. So that's really what happened is you had all of these mortgage-backed securities, the collateral that was being used to a great extent in repo and to create these dollar-denominated loans and all the lending and all the financial engineering that the economy was really being built around, that comes crashing down. And it wasn't necessarily the housing market. That was just the bad collateral that was being used, that was being seen as pristine collateral, like the T-bills are being seen now. So you have the euro dollar funding market or dollar market going down. And what that has to be replaced with is the dollars being created by the government and by the Fed increasing, or else we would see significant amounts of deflation like we saw in the 1930s. So that's why you see the deficits of the United States government just skyrocket. And then you see the Fed's balance sheet skyrocket as well in an attempt to try to keep the long end of the yield curve down. Now, I would argue that they actually do the opposite when they try to do quantitative easing. But that's really what they're trying to do. They're trying to plug the hole that's left by the collapse of the Eurodollar system, and a system that's just now, it's like sputtering. It's like an engine that's kind of on its last leg. It's an 8-cylinder engine that's only running on 4 cylinders. It's only, it's leaking oil. The spark plugs need to be changed. The tires are flat or whatever. That's the Eurodollar system right now. And the Fed and the government are just trying to fill the hole with all this excess liquidity with, $800 billion a day now in reverse repos with the Fed, the government running $5 trillion deficits. I did a video the other day on comparing the 3 systems of dollar creation, one that we had in the past, one that we have now, and one that I think that we're going to get into in the future with a central bank digital currency. And I pointed out that the deficit the government ran that was so extreme, most economists it couldn't even fathom what was going on. And what I'm talking about was the GFC, when they did all the bailouts and everything.
Yeah.
The government deficit back then was 1.4 trillion. 1.4 trillion. The deficit in 2020 was almost 5 trillion. 5 trillion for a quote unquote recession. That's their response. So what you've seen is the amount of quantitative easing go up and up and up. Remember when Ben Bernanke came out and said that we were going to do QE, he didn't say that it was going to be QE1.
Right.
He just said that it was going to be QE, meaning that we're only going to have one. But then we get QE2, QE3. And I'd like to remind everyone that QE3 was just supposed to be this bazooka of liquidity that would completely overwhelm the market. Well, that was $80 billion a month.
Right.
Okay.
Yeah.
I'd like to remind everyone right now what we're doing in supposedly a booming economy. You read CNBC, you read Bloomberg, every single headline is that the United States economy is on fire.
Mm-hmm.
But yet we're still doing not 80 billion a month, but 120 billion a month.
Mm-hmm.
So on the surface, it looks like the economy is doing okay, but underneath, you have to understand that the entire thing is broken. And it goes back to the euro dollar market being broken, in my opinion, the euro dollar market being broken, the dollar monetary system itself being broken, the amounts of debt that we have in the system being at all-time highs at the consumer level, the corporate level, the sovereign level. And then it goes back to the amount of regulations that we have. It goes back to the amount of taxes. So we can't get these animal spirits. And that's the position that we're in right now. And I think that's why everyone pretty much agrees that you've either got to have a collapse of the system. And this goes back to the Austrian school, where they would say that you need to get all of that malinvestment. You need to get all of the misallocation of resources out of the system. And it's going to be extremely painful to do that. But that is the only way that you can get yourself back on some sort of solid ground to where you can start building the economy again in a way that is structurally sound. And a lot of those people that we talked about believe that for the United States really isn't going to be possible unless the dollar is no longer the reserve currency. A lot of people talk about the exorbitant privilege that we have had as the dollar, as having the dollar as the global reserve currency, and there's no doubt about that. It has definitely allowed Americans to consume way above their means and consume far more than they actually produce. But it's also hollowed out our manufacturing base. So whenever you're looking at something like this, you always have to look at a cost benefit analysis. And when most economists look at the dollar, they only look at the benefits. They do not look at the costs. And so the costs are the creating the stuff that we need here in the US, or some stuff, that we can actually trade with other countries. So if the dollar, if it does collapse, if the system collapses, at least, the phoenix rising up from the ashes would be the United States being able to be in a much better position to create that solid economy that it wouldn't have to be completely manufacturing based, right? But we'd have to produce more than we consume. And, hopefully we'll get there. But I agree with the Austrians. And I think most other really smart people do, and that you've got to have a collapse of the system before you get to the point where you can start growing again. I always use the example of a heroin addict, and people, on the Keynesian side and whatnot, they'll always talk about why don't we just do a debt jubilee? You always hear that with Japan.
Right.
Well, listen, the Bank of Japan owns 60% of the JGBs, which is the government debt. So if that's just involving two balance sheets, what would happen if the Bank of Japan just came in one morning and just hit delete on the 60% of the JGBs they own, and that liability for the government would also just go poof, gone. And now all of a sudden your debt to GDP in Japan goes from, let's say, 225% debt to GDP down to 100%. Would anyone even know? And the answer is probably not, right? But what most people don't think through is, like a heroin addict, the damage has already been done. It's not what would happen in the future to the yen or the JGB market. It's what has happened in the past to the economy as a result of the government spending in the first place. Because the government spending is like the heroin. That's what distorts the economy. That's what creates the malinvestment and the misallocation of resources. So it's like if you gave someone that was a heroin addict a credit card for $100,000, and what would they do? They'd run that up buying more and more and more heroin, right? Well, they'd buy maybe enough heroin, and they'd have to buy ever increasing amounts to get the same effect, but they'd buy enough of it and more amounts of it to max out the card. And that's like saying, well, if we just give that guy a debt jubilee,
right,
and bring his credit card back down to a zero balance,
right,
well, now all of a sudden he's good to go. No, because the damage has already been done. His brain is already fried. His body is already destroyed. And by giving him another credit card with $100,000, it's just going to make the matter worse. The only option is to get that guy in rehab and have him go through the pain of the withdrawals to get him off the heroin in the first place. And then he can start to become healthy again. And I think it's exactly the same with the United States and the economies in the developed world.
Okay. Yeah. No, given that that's the case and that collapse is that rehab scenario. And George, just in general, given the complexity of the financial economy and therefore the vulnerabilities that lie therein, talk to me about how you're positioned. How do you take the information that you distill from the conversations you have on your show and build that into a portfolio that's going to take care of you? What does your portfolio look like today?
Yeah, so I call it a 10-80-10 portfolio. So 10% of it would be what I consider gold, what I consider insurance, which is physical gold.
And is that exclusively gold, your insurance?
I'm sorry?
Is that 10% insurance exclusively gold, or are there other assets in there? Okay, got it.
Just gold. Just gold. Yep.
Good.
And then 80% in it would be what I consider investments. So that's something that pays me to own it. And that's just my definition. And then the other 10% would be in speculative assets where I think there's a lot of asymmetry.
Yeah.
And but it might not pay me to own it. And an example of that would be back in March of 2020, I bought a lot of uranium, a lot of gold miners, even some juniors, stuff like that. Those weren't really paying me to own them, but I thought they'd be a good speculation. Bitcoin, I think, would fall into that category. But Bitcoin, I think you really got to be careful about when you buy and the emotion in the market. That's another thing, going back to Jim Rogers. I always like to buy things when they're cheap, and I like to sell them when they're expensive, regardless of whether it's an investment or especially when it's a speculation. And to kind of get a gauge on that, I think that if you consistently buy when there's panic and when you sell when there's hysteria, I think over the long run, you're going to be doing okay.
Yeah.
And, there was extreme panic in the market back in March of 2020. That's when you want to buy. Another example of that when I bought, I don't buy that often, to be honest with you, but another example of that when I bought a significant amount was when Cyprus had the bail-ins. I don't know if you remember that back in 2000, I think it was 13 now.
Okay.
Remember when they did the bail-ins with the banks?
Yeah. Okay.
And their stock market went down by 99%.
Okay. Yeah.
That was panic. So I went in and bought quite a bit back then. And that's what I like doing, other than, or kind of laying that over the framework of just buying things when they're cheap and selling them when they're expensive. Commodities are a lot easier for me to do that. That's why I like commodities a little bit better, because for me, as an amateur, it's pretty easy for me to tell when oil is cheap.
Sure.
It's pretty easy for me to tell when it's expensive. All you got to do is just look at a chart adjusted for inflation. And, when it gets under 30, it's pretty darn cheap. When it gets over 80 or 85, it's starting to get expensive. And then it's usually going to revert back to that mean. So that's kind of an example of how I set things up. Now, though, I think you really need to, especially as an American, but as a citizen of any country, really, I think you need to diversify your political risk, and you also need to diversify your currency risk. Because we're moving into a time when this global elite narrative that's being pushed by groups like the World Economic Forum is really gaining a lot of traction. And I would argue that you probably don't want to do a lot of investing in countries that are drinking that Kool-Aid.
Sure.
Because they're going to be very unfriendly to capital. Unfortunately, Canada is one that is drinking the World Economic Forum Kool-Aid. They're not just drinking it; they're like beer bonging it. They're slamming it down. And Australia is another one. New Zealand, the United States, kind of I think we're just teetering back and forth. But I think it would behoove people to have some assets and some cash flow in countries that most likely won't go along with that, because from an economic standpoint, it would not behoove them at all. And so those are countries such as the Middle East, Eastern Europe, Brazil might be another one. But I'm not saying have all your assets over there. People take that to an extreme. Sure. Because another thing that you have to understand is how, when you're constructing your portfolio, you need to ask yourself what your bills and your expenses are denominated in, because you don't want too much FX risk. Right. So let's just say that you were living in Texas. We talked about that earlier. Well, the majority of your bills would be denominated in dollars. So with that 80% of your portfolio, you wouldn't want that exclusively in Colombian pesos, because if you get a big swing with the peso, if the dollar really goes up and your income is in pesos, but your expenses are in dollars, that's going to be a problem. Right. So when I say diversification, what I do is I kind of just say, all right, what are my expenses going to be in this year? And then I want at least 60% or so of the cash flow that's coming in from that 80% to be denominated in that specific currency. But I do want some diversity for all of the reasons that we discussed before. And, there's going to be a lot of countries in the future that I think are going to be very, very unfriendly to capital, and unfortunately to people who really produce and create jobs. And that's going to be another contributing factor into if and when we do have a crash, how is the United States going to fare? Well, it really depends on what the societal narrative is around how we're treating people who produce businesses, who take risks and create jobs. Are we going to tax them at 90% and demonize them? Or are we just going to set up a platform that where we have rule of law, where we have a sound currency, where we have a low tax system, and we let entrepreneurs just do what they do, and take everyone up with the invisible hand that moves the market, going back to Adam Smith. Right. So that's a big question, but that's kind of why I like to have that diversity. And thank goodness that when you do get outside of the United States or Canada or some of the Western markets, there are some great cheap companies that pay fantastic dividends that are in the commodity space. which again, I like because it's tough for a commodity to go to zero. And there's opportunity out there. It's just there's not much opportunity in the typical way people invest. And that's just your average Joe and Jane not really knowing what to do. So they go down to their local financial planner, and the financial planner just sets them up in this stock bond portfolio, 60-40 split, or maybe it's based on their age or something like that. That's as Jim Rogers says, that's a quick path to the poorhouse. And the reason is going back to another good friend of mine, Chris Cole, who has done extensive research going back 100 years. And he did this in his paper called The Allegory of the Hawk and Serpent, where he outlines the now famous dragon portfolio. But he back tests all of these popular strategies, even risk parity, that Dalio puts on. And he shows, and buy the dip and all these other things. And he shows that if you would have done this from 1920 to like 1980, you would have gone bust like 2 or 3 times.
Sure.
In that span. The only reason that what the financial planners suggest you do or try to push you into or really promote, the reason that's worked is because we've been in a down cycle in interest rates since 1981.
Right.
So how can you say that the next 40 years is going to be identical to the next or to the last 40 years when interest rates have gone from 18% down to 0%?
Yeah,
that's just completely irrational to make that argument. But unfortunately, the average Joe and Jane don't understand that. And what they need to understand is that all the Western economies have to have a deleveraging. They have to have a deleveraging. The only question is, are we going to have a deflationary deleveraging, or are we going to have an inflationary deleveraging? Because the debts are just too high. That's the one thing that we all know. And ironically, how do you create inflation? Well, you have to create more currency. How do you create more currency? You create it through lending. Well, if there's no balance sheet capacity for people to take additional loans, how do you create the additional currency needed to create the inflation you need to bail yourself out by paying that debt back with a devalued fiat currency, whether it's the dollar, the euro, the yen? It's almost impossible unless you get this hybrid system, which I think we're in right now, where the government is spending so much of this, or their deficit spending to such a degree that the Fed is monetizing, that's actually increasing the broad money that could actually give us the inflation without having the banks actually lend more dollars into existence. Because if you look at a chart of bank lending in 2020, it really spikes up when we had all those PPP loans. But since then, it's really gone down. And so if the commercial banking system is in charge of creating all the new dollars, which they have been for decades, well, then we should see massive deflation, because the amount of dollars in the system should actually be decreasing, not increasing. But anyone that looks at a chart of M2 money supply can see that it's gone up by almost 25% in 2020 alone. So how does that happen if the commercial banks are creating fewer dollars? Well, it's because the government is spending the money into existence, and then they're just flipping those bonds or those treasuries right over to the Fed, who are buying them with newly created bank reserves. So now how long that can last, who knows? But that's that's where it goes from an economic question to a political question. And that's very difficult. But I think what's going to happen longer term, because I think the central banks know that they're, as Jeff Snyder would say, they're not central, and they know that they don't have control over the dollar at all. Everyone thinks they do, and if you turn on CNBC, they think that the Fed is controlling everything, but the Fed controls very, very little, especially when it comes to creating dollars. And I think they know that. So I believe that in the future, again, no certainties, only probabilities, but I think the probabilities are very high that we go into a central bank digital currency, because then if all the entities and the individuals in the real economy had an account with the Fed, they would be able to turn those bank reserves into legal tender. So people would actually be able to spend the base money that the Fed can actually control and create out of thin air. Therefore, the Fed takes control over lending from the commercial banking system. And by definition, they also take control over the creation of dollars. And that's where we can get the enough dollars being created to make up for the lack of dollars being created by the commercial banking system and the Eurodollar system to create the inflation they need to bail out the United States government, which now has 29 trillion of on-balance sheet debt. So I think that's kind of the way the future plays out. It's kind of my base case.
Interesting. All right. Look, George, it's been great having you on. Thanks so much for making the time and getting in front of my audience. I appreciate it. And it's about time that we did this. So thank you.
Yeah, no problem. I apologize. I went off on that monologue for about an hour. I think you only asked me one question. My fault. I'll try to let you ask me a few more questions next time.
It was fun, man. No, I appreciate it. As always, if you enjoy this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.